In today's video, we will be going over 4 different ways that you can access the equity inside of your house in order to purchase cash flowing real estate. And you will be able to decide which strategy is best for you. Not a lot of people know that you can actually put the equity inside of your house to work and purchase cash flowing assets that appreciate in value. And every day that you wait to capitalize on that equity, inflation is slowly eating away your future profits. And lastly, before we begin, if this video is of any value to you, it would be greatly appreciated if you hit that thumbs up button for me. It would help the YouTube algorithm and it would help out my channel a ton. Real quick, for those of you that do not fully understand what home equity is, it is the difference between what your property is worth and how much you owe on that property. So let's say you have a property that's worth $100,000 and you have a mortgage on that for $50,000. That means that you have $50,000 of equity just sitting there waiting to be used. But if you use one of the 4 strategies I'm about to talk about, you could build massive wealth with your home's equity. Now, the first strategy is a HELOC, which is a home equity line of credit. A home equity line of credit is a way to leverage against the equity you have inside of your home and get a secure line of credit that you can access on the equity that you have. A home equity line of credit can leverage against the equity you have in a primary or investment property. Think of a home equity line of credit very similar to a credit card, to where you can draw from it, pay off the balance, and then draw from it again. But it's a little different. With a home equity line of credit, you have a draw period and then a repayment period. Typically, the first 10 years will be the draw period to which you can use it as you wish. And with the draw period, you only have to pay interest-only payments on the money that you use for that first 10 years. But after that draw period, you would then go into the repayment period, to where you would pay back principal and interest of the money that you still owe. The pros to a home equity line of credit is that once you get access to it, you do not get charged unless you actually use the home equity line of credit. So if you get approved for it, you get the access to those funds, but you don't touch it, then you don't have a payment. Meaning that you can save this in order to find the right rental property to purchase, or you could save it for emergencies. Also, for the first 10 years, it's interest-only payment. But the major con to a home equity line of credit is that it is a variable interest rate, meaning that the interest rate fluctuates with the prime rate of the market. So let's say you get approved for 5% when you first pull out a home equity line of credit. It does not mean that with the market, it could rise to something like 7 or 8%. And just for a real life example, I actually got approved for a home equity line of credit at 4.5% a couple years ago, and today it's at about an 8%. So that's why you have to be extremely careful when using a home equity line of credit and almost plan for the interest rate to go up so you are not caught in a bad situation. Depending on where you go and what bank you use, you can typically get around 80 to 90% loan to value on a home equity line of credit. And with an investment property, it's seen as more of a risk, so I've seen anywhere between 70 and 80% loan to value on an investment property. Now, here are a few things I want you to keep in mind when using a home equity line of credit to purchase a cash flowing property. Number 1, always use a home equity line of credit for shorter term debt. And the reason I say that is because the variable interest rate may rise and increase your payment quite a bit, to where a deal may not make sense anymore. Strategies that you can use this on are something like fix and flips, live-in flips, or the BRRRR strategy. Number 2, make sure that the property cash flows enough to where it pays all the expenses on the property and the monthly payment that it costs in order to pay off the HELOC. And number 3, prepare for the worst when it comes to the interest rate. When you're analyzing deals, make sure to jack up that interest rate just in case it does increase and you have drawn out money from that home equity line of credit. You'd rather be more safe than sorry. Moving on to the second strategy, which is a home equity loan. It sounds exactly as it is. It is a loan that you get based off of the equity that you have inside of your property. And you agree on terms and pay back the bank monthly on the money that you use plus interest. Now, there are 2 reasons that someone may want to go this route in order to purchase a cash flowing rental property. The first being with a
home equity loan.
You can get a fixed interest rate, so you do not have to worry about the prime rate, and you don't have to worry about it fluctuating the term of your loan. This is nice because when analyzing rental properties, you would know the exact expense it would be every single month. Another reason that someone may go this route is because they have located a property already and all they need is the money in order to fund it. But the drawback to a home equity line of credit is that you start paying right away, even if you don't use the money. You see, a home equity loan is very similar to a car loan, to where they give it to you and you start paying right away. But even though you get that money from your home's equity and you put it into your bank account, if you do not use it, you are still responsible responsible for paying the bank back every single month. A home equity loan is also a great way to lower your debt to income ratio in order to qualify for a rental property or to restructure debt to have lower monthly costs. Let's say you have a car loan at $20,000 and an 8% interest rate. If you're able to go to the bank, get $20,000 from the equity inside of your house and get it at a 5% fixed rate, that means you're saving 3% on interest. Moving on to the third strategy, which is a cash out refinance. Essentially, a cash out refinance is taking out a higher mortgage on your property, paying off the lower mortgage you currently have, and taking out a lump sum of money that you can put in your bank account, and that is tax-free. If I didn't explain that well, let me give you a quick example. Let's say you own a home worth $500,000 and you owe $300,000 still on that property. Just like a HELOC or a home equity loan, you would go to the bank and see if they're willing to do a cash out refinance, which typical rates on a primary home would be a roughly 75 to 80% loan to value. So the bank agrees to give you a new loan at 80% loan to value on your property's value, which is $400,000. From there, you would subtract the $300,000 of debt you owe on that property, which leaves you with $100,000 that you can take out and have tax-free money. Now, the drawback, and the majority of the time doing a cash out refinance, you will have a larger monthly mortgage payment than you did before. By taking out more debt on the property, and depending on your interest rate that you receive, if it's higher or lower than what you currently have, will raise your monthly payment. This could be a great resource for someone that can get a lower interest rate than what they had before, and they can keep the monthly mortgage payment as close as possible to what they had before, all while taking out a lump sum of cash that is tax-free, and you can invest in real estate. The most popular way to use this strategy is by doing the BRRRR strategy, which is buying an undervalued property, renting out the property to market standards, refinancing, taking cash out, and going and repeating the whole process. You can use a cash out refinance on both a primary or an investment property. Now, the fourth strategy in order to access the equity inside your house is to sell it. And you might be thinking, okay, Captain Obvious, if I go and sell my house to purchase a rental property, I'll be homeless. But just hear me out for a second. There are three ways that I can see being very beneficial if you sell your house to get the equity outside of your house. The first way, and very simple, is to go and downgrade the house that you have if you have a lot of equity inside your current home. Buy a smaller, lower cost home and sacrifice for just a year. If you're willing to do that, you can use an FHA 3.5% down loan to put little money down on that new downgraded lower cost home. And from the rest of the profits that you have from selling, you could go and purchase a rental property. The second way is to purchase a 2 to 4 unit multifamily house hack. Basically what that is you would buy a 2 to 4 unit residential building to where you would live in one of the units and rent out the other units. By doing that, you will have income coming in for the other units that you rented, and it may pay down or completely wipe out your monthly expense when it comes to living. What that'll do is allow you to save at such a higher pace, and after 1 year of living there, you can purchase another home to go live in while having a rental property. Better yet, if you use the FHA 3.5% down for that house hack, you could purchase another property with the other profits you have, and then bam, you have 2 rental properties. When you move out after a year, then you'll have 3 properties you own, 2 of them being a rental property. So in less than a year, you will go from 1 property to owning 3. And the third way is to do a live and flip. Basically, you would buy a undervalued property that you know you can fix up, raise the value, and move into it, start fixing it up while you live there. And after you're done fixing it up, you can either sell it, move out, do it again, and make a good profit on it, or you could go ahead, refinance it, take money out of it, and then go buy a rental property. All 4 of these strategies are great ways to access the equity inside of your house in order to purchase rental properties. The one thing I will say is to make sure you do your due diligence and run your numbers 1,000 times to make sure that you're accounting for everything. Thank you everybody so much. Don't forget to give this a thumbs up, and I will see you guys in the next one. Happy investing.